So your voice is not audible.
No, I'm here. Uh, Actually, I am facing some issue with my camera. Okay, but see, already I gave the question, so you can take a 10-minute time, okay, and read the simulation question so that we can solve it. Am I audible properly?
Yes, sir.
Yeah. So you can start to. Shutdown करून टाकते का? हाँ मीटिंग डिस्कनेक्ट करूँगा. Okay. Okay, so you can start to read this question. No, it is okay. So once you finish, you can just raise the voice. So you just need to say whether the ratio get increase or decrease with respect to means before taking any decision. I mean, or before implementing any strategy. So can we start now? Okay. So like first strategy, factor 200,000 of account receivable without recourse proceed from this transaction would total 175,000 net of 20,000 fee. Okay, so what happened? Like account receivable goes down by 200,000, but we are receiving a cash of 175,000. Okay, this is the first strategy. And in second strategy, we are borrowing 200,000 bank from a bank. So it will increase the cash of 200,000 without impacting account receivable or any other current asset or current liability. Okay, current liability is also not impacted because it is a 2 years repayment. Okay, so there is no change in the current liability in both the cases. Okay, only current asset get changed. Okay, so in first case, like current asset decrease by 25,000, and in second case the current asset, because the cash get increased. Okay, and the liability goes to non-current liability because we are paying after 2 years. Okay, so in second case, current asset increased by 200,000. So in first case, strategy one, current asset decreased by 25,000, and in second case, current asset increased by 200,000. Okay, so we'll see. So quick ratio is 0.7. Okay, so what does it mean? In quick ratio, we generally like consider the current asset minus inventory minus prepaid expenses. Keep in mind. Okay, for current ratio, current asset divided by current liability. But for quick ratio, current asset minus inventory minus prepaid expenses. Okay, so as compared to numerator and denominator, here the adjustment is in cash and account receivable. Both are part of current ratio. Okay, so in this situation, in strategy one, what happened? If I consider like 0.7 means 70,000 is a current asset and 100,000 is current liability. Okay, so what would be the next after in strategy one, after adjustment, it is basically minus 25,000. Why? Because debtors and creditors, debtors reduced by 175 200,000, but the cash increased by debtor increased by reduced by 175,000 200,000, but cash increased by 175,000. So net impact is reduction of 25,000 in a current asset. Okay, so that would be the next ratio. So it is, so as compared to 0.7, 0.5 means it is decrease. Okay, in a second case again 70,000 divided by 100,000. This is the, I mean, just to consider the 0.7 impact. And now what happened here? Here the 200,000 get increased. Okay, the second effect goes to non-current liability. So impact is, as compared to 0.7, it is increased. So here decrease and here increase. So decrease, sorry. Okay, so decrease and increase you can consider. So I'll just, yellow is a decrease and the other color is, sorry, this is basically the increase, okay, that we consider. Inventory turnover. So in inventory turnover, we are using the inventory and the cost of goods sold for calculation of the ratio. There is no impact because of sales, account receivable or the cash. Okay, so that's why there is no change. No change. Same here. Next, account receivable turnover. So here what happened, if I consider the 6.5 account receivable turnover, means the debtors is 200,000. If I consider the debtors 200,000, so 200 multiplied by 6.5. Divided by 200, or I'll consider account receivable. Yeah, this is 6.5. Yeah, so because the debtors is now, okay, so debtors get reduced. Okay, and the sales as it is. Okay, so in that situation, I mean, if I calculate, because 200 instead of, I'll keep 300 and here also the 300. So ratio is again 6.5. But what happened? Now the debtors get reduced. So this debtor reduced by 100, 200,000. So now it is 100. Sale is my as it is, but the denominator goes down. So again it is decrease. Sorry, increase. Okay, it is as compared to 1.7. Now it is 6.5. It is 19.5. So it is increase. Okay. In strategy 2, what happened? The cash will get increased. Okay. So it is no impact. There is no impact on debtors. Next, current ratio. Okay. So in current ratio, if you see in denominator, there is no impact on denominator, but in numerator, there is a reduction of 25,000. Okay. So again, it is decrease. Okay, the same way in current ratio, here the cash will increase. Okay, so here the ratio get increased. There is no impact on a debtors, only there is no impact on current liability, only current asset get increased. So that's why the ratio is also get increased. Debt to equity ratio, so again there is no impact, and the profit margin ratio, there is no impact. Are you able to understand? Any doubt here? Okay, so we are going to move on second question. So this kind of questions you will get in a simulation. Okay. Yeah, now you can start with the second question. You can take a 10-minute time. And if you complete before that, just inform. Can we start? Within 10 days throughout the year. First, like we will see the task one. Okay. So purchase all the timber from one vendor with the standard payment of 30 days. If like Mitro pays the invoices for the timber within 10 days of the invoice date, it receives 1.5% discount. Okay. Pays the invoices timber, after that it does not receive any discount. Okay, during the prior month consolidated revenue reached 100 million with the cost of sales 50 million. Okay, below enter the applicable percentage associated with the column B. Okay, so assuming 365, what is the effective interest rate that Mitro earns by consistently paying? If he is paying in a 10 days, what is the normal credit period? 30 days. Okay, and if he pay in a 10 days, then he can 10 days, then he can save 1.5%. Okay, so how we are going to calculate? See, I'll just write here discount 1.5%. Then like discounted credit period, this is 10 days, normal 30 days, 30 days. Okay, so first keep in mind how many times we are going to pay, so that how we can decide 365 total days in a year, and the cycle we can calculate from 30 minus 10. So this is basically the number of cycles, which is 18.25, and in one cycle we are earning 1.5 divided by 100 minus 1.5. Okay, because we are actually paying 98.5. Okay, so this is the saving for per cycle. Okay, now 18.25 multiplied by this one, so it is 27.28%. 27.78%, sorry. Okay, are you clear with this? Means how I am applying this formula? See, we are paying 20 days in advance. So number of 20 days, how many cycle we are using? Means per cycle 20 days. Okay, so number of cycle we can calculate 365 divided by normal credit period minus discounted credit period. Okay, per cycle benefit is 1.5% discount on payment of 98.5. So which is 0.015 or 1.52%. Okay, so if I multiply, I mean the per cycle 1.52% we are getting the benefit. If I multiply with the number of cycle, then this is basic in a year, then this is basically yearly saving, which is 27.78%. Clear? Now second, if revenue and cost of goods sold increase by 10% and 2% respectively, what would be the Mitro's gross margin? Okay, so in a gross margin, okay, so in a gross margin, basically we are not going to consider the effect of that discount, because this is like I mean whatever may be the saving or expenses, that is after the gross margin. Okay, so what is the sale and purchase numbers? reach 100 million with a cost of 50 million. Means right now it is 15%, 50%. So sale is 100 and the 50 is basically the cost. Sales, cost of goods sold. Okay. So what is GP margin? Is basically this divided, sorry, this multiplied by 100. So this is my GP margin. Hmm? Yeah, 50%. Okay. Now, in a revise, what is the situation? Like sale price, revenue and cost of goods increase 10% and 2%. Okay. So sales will become 110 and this has become 54. I think not 54, 51. Sorry. Okay. So gross profit margin is 54%. Okay. So this is 54 is the second question answer. Now task 2. Factoring. Okay. So one of Mitro's business unit is considering factoring 1 million of account receivable on a without recourse basis. Without recourse basis means if any loss happened, that is absorbed by the factorer. So factor assigns a finance charge of 2% of the amount of account receivable factored. The factor retains an amount equal to 3% of the account receivable factored for a probable adjustment. Amount receivable factored. And sold a collection of furniture 1.5 euros to a retailer in a country located in eurozone. The exchange rate is okay. So first you need to calculate only what is the amount receivable. Okay, so it is like AR 1 million. Okay, out and the 2% factoring fees. Factoring fees 1 million multiplied by 2%, which is 20,000, and the 3% is retention. So it is 1 million multiplied by 3%. Okay, so what is net? So 950,000 is amount receivable. Okay, so no, not a much complicated question. Then what is the foreign exchange gain loss that Mitro realizes at the end of its current reporting period, resulting from adjusting the value of the account receivable balances to the new, I mean the restatement we need to do. Okay, so 1.5 million euro at a retailer in a country located in eurozone with the exchange rate of 1.1 euro equals to $1.2. Okay, so Mitro's functional currency in this country in the US dollar. At the end of the country's reporting period, Mitro collected the payment in euros for the sale of furniture when the exchange rate was 1.10. Okay, so 1 euro equals to 1.112 and now it is 1.10. Okay, so what happened? Because we are going to collect 1.5 million. Okay, see earlier I need to pay more euro, but now I need to pay a less euro. Okay, so that means US dollar goes down. So there may be a loss may happen. Okay, so 1.5 million euro. This is one. So in US dollar at the time of sell 1.2, which is 180,000. 1.5 million, yeah, 180, 1.8 million US dollar. This is euro. Now the euro is same, and this is a receivable. So at the time of sale, I assume I am receiving 1.8 million, but now actually I am receiving 1.1, which is 165,000. Okay, so there is a loss. Means I supposed to receive 180,000 1.8 million USD, but I am receiving 1.65 million USD. Okay, so there is a loss of 150,000. Okay, so this is basically the second task answer. Now task 3. Okay, so we need to calculate operating cycle and the cash conversion cycle. Okay, so can anyone tell, I mean, what is the formula for operating cycle and what is the formula for cash conversion cycle? Can anyone aware? See, if you're not going to involve, then I don't, I mean, I'm not able to like understand whether you people are, I mean, whatever I teach you, whether you are able to understand or not. This is a very simple question. Operating cycle. Operating cycle is basically debtors and the debtors turnover and inventory turnover. This is operating cycle, and if I reduce the payable turnover, then this will become a cash conversion cycle. Okay, so like if you see, first one is sale of goods and collection of the payment. This is basically the debtors turnover. Okay, so AR days, which is 20. Then the number of days between delivery of raw material and payment for those this is basically the AP, account payable, that we need to reduce for calculating the cash conversion. This is not the part of operating cycle. And the number of days between the initial investment in inventories and the final date of sale, when the title has been transferred. Okay, so if it is given the title has been transferred, means on the day of the purchase. Okay, so it is 30 days. So this is basically the inventory days. Okay, days, which is 30. Okay, so operating cycle is basically the 50 days. Okay, this is my operating cycle. Okay, then AP cycle, that need to reduce. Okay, how much? 45 days minus 45. So cash conversion cycle is a 5 days. Okay. Yeah. So you can take a again 10-minute time or 14-minute time to read this question so that we can solve. Okay. So weighted average cost of capital. Okay. So first, so what the company has a stock. Cost of return earning. Cost of return earning is more or less whatever may be the cost of stock. Okay, so for that we need to and like we can calculate the cost of common stock or the return earning on the basis of dividend growth model. Okay, so dividend growth model, what it suggests, D1 divided by um, cost of return. Okay, so it is simple actually, D1 multiplied by growth rate, because we are not calculating the price only. So what is my dividend at this moment? Dividend, they may give, okay, 4.7 is the market price and 0.363 is a dividend. So dividend percentage is uh, 0.363. 363 divided by 4.7. 4.7. Okay, so that is my cost of equity at this moment, and then I need to apply the growth rate. So growth rate is, okay, so I multiplied by, what is the growth rate? Somewhere they give the growth rate. Okay, 4.1%. So 1.041. So that is basically the 8.04%, and then again we need to add the 4.1 plus 0 4.1. What is this? 12.14%. Okay, so that is basically the, or 12.1% you can consider. That is basically the cost of return earning. Cost of return earning. How I calculated this? Because I know the market value, I know the dividend. We need to increase the dividend for 1 year. Okay, so we need to calculate the D1, and that's why what I did, 0.363 multiplied by 1.041 and then divide by current market price. So that will give me a like whatever may be the dividend rate, and then I added the growth rate, and this will become a cost of return earning. So 12.14% is my cost of return earning. Then cost of preferred stock. So it is easy to calculate. Data stream. 12% preferred stock at par value, trading at 12. So it is 12 divided by 12. So like 10%. It is clear. Okay. So cost of preferred stock. 0.10, 10%. Then the next question. After tax cost of debt. 7% bond trading at 1045 x interest and the pre-tax cost is 6.86. Pre-tax cost is 6.86 where they gave the tax percentage. Tax rate. Here you do not require to have because the pre-tax they already gave. So 6.86 and I just need to tax rate I need to reduce it. Yeah, here the income tax 30%. So 6.86 multiplied by 70%, that is cost of debt. So it is 6.86 pre-tax. Okay, so this multiplied by 1 minus tax rate. So it is basically 4.80, 4.8%. So that is my cost of debt. Then after tax cost of total market value of common stock. Total market value of the we know currently trading at a 4.7. Okay, so we need to know the number of common stock so that we can get it from the balance sheet somewhere. Current asset, shareholders equity 1 million. Common stock 400,000. But we should know the face value. Number of common stock. $4 million. Par value 10. Okay, here they give. See, common stock par value 0.5 per share. So 4 million is a value. So number of common stock we can calculate. The total value is 4 million. Divided by per share price, which is 0.5. It is total number of common stock. Okay, and the market value, we know the market price. So that's why the 8 million multiplied by 4.7, that is my market valuation. So it is 37.60 million, I think. Yeah, or 37.6 million. That is the market value of the common stock. Okay, then next question. Market value of preferred stock. Okay, so what is the market value of the preferred stock? So again, we need to calculate the number of common stock. Okay, so sorry, preferred stock. Preferred stock. Number of preferred stock is basically that we need to see. preference shares, par value is 10 per share. So if I go to the balance sheet, so here total value of 1 million and the per share is 10. So we can calculate. 1 million is total value, divide by 10. So this is number of stock. So market value is, we know that 12 is the per preference shares value. So it is basically the 1.2 million. 100,000. Yeah, 1.2 million. Market value of preference stock. Then maybe the total market value of bond. So they are trading at 1045 x interest. So we need to consider x interest only. If it is inclusive of interest, then you need to reduce the interest amount. Okay, but here x interest price they already gave. So bond value is 3 million. So 3 million divided by 1000 means number of bond, and then multiplied by what is the trading value? 1045. Okay, so again stock, sorry, bond. So what is this? 3 million divided by 1000, and then we need to multiply it by 1045. Okay, so it is 3.135 million. Okay, now if you see retain earning, if you want to calculate the weighted average cost of capital, retain earning, common stock, preferred stock, and the bonds. We know the market value. Retain earning we can get it from balance sheet.
It's 12%.
8 million. Yeah. Anyone has any doubt?
No, sir.
Yeah. So it is retain earning is 8 million. I picked up from here retain earning they gave, and then I need to consider the balance sheet like a market valuation. So common stock is basically 37.60. Okay. Then preferred stock is 1.2 and the bond is 3.13. So this is my total constitution of the capital, which is 4993. Okay. If I took the market value, then I don't require to take the return. Yeah, 41.93. Return earning we are not going to take because we are considering the common stock in a common stock at market valuation. Okay, and then we are aware the cost of common stock means the same cost of return earning is basically the cost of common stock. So that number return earning it is 12.14%, 10%, and 4.80. Sorry, 14%, then 10%, and here what is 4.8%. Okay, then we can calculate. this multiplied by this, this. So on total investment, market valuation of 41.935 thousand. My cost of weighted average cost of capital is 11.53 or 11.5%. Clear?
Yes, sir.
Yeah. Okay. So here we will take a 15-minute break and then we start with the question number 4. Okay.
I had some calculation.
Yeah.
In my calculation, it come well,
How much?
11.2%.
Okay. So we can check from here. So what is your like common stock? I mean, you consider this number, I mean the market value, common stock, preferred stock, or bond.
Yes, sir.
Okay, and then the percentage cost of capital, 12.14, 10, 4.80, or is there any?
Yes,
Okay, the same percentage you took, but then it is a
sir. 4.7, 4.8, 8,000 plus
four
multiplied by 4.7.
4.7. I mean, where you took the 4.7? Means for bond or common stock or preferred stock?
Market value.
Sorry, again.
Market value.
Market value of which item? Means common stock, preferred. Your market value is
8 million. 8 million. 8 million.
8 million from where? Means retain earning also you took. That you are saying?
Yes, sir.
No, retain earning is not required because we took a common stock at a market value. See, keep in mind, retain because the common stock valuation largely depend on the retain earning. So if you take the market value for calculation of the common stock, then you do not require to take the retain earning. It is already factored in the market value of the common stock.
Okay.
Yeah, okay. So this way we need to do. Okay, so we can take a 15-minute break here. We will join on 8:45. Okay. Okay. So can we start now? You can take a 10-minute time to read this question and then we start to solve. And if you can finish before that, just raise your voice.
we can start.
Okay, so it is done. We can go one by one. Optimum order tries to be booked. Okay, so what would be the optimum tries to be ordered? So what would be the optimum order entry that we need to see? So it is basically the economic order or quantity you need to calculate. Okay. So they gave the data. First, yeah. So have you calculated the annual demand?
Yes, sir.
What is that?
300 answer. Like 2 times 500 multiplied by 2 times. Multiplied by 12. Okay, 12,000.
Okay.
Okay, cost of that 20%. So 20% divided by 2.5. It is, but
Again, I mean one by one. Like how you started from 500.
yeah, 500 multiplied by 2 times by second. Multiplied by 2. Multiplied by 12.
Again, annual demand. How you calculated? One by one. First, you took a 500 bicycle.
Yes, sir.
Then
2 times multiplied by 2 times.
not able to hear your voice clearly. 500 and bicycle
Multiplied
one
by
multiplied by 12.
yes.
Which is
Two.
yeah, but it is bicycle in a month. So for 12 months it is
Yes.
6,000 and then multiplied by 2. So this is your annual demand.
Yes, sir.
Okay.
And 20% is a cost per liter.
Hmm.
So 20% multiplied by $25. It was
20.
equals to 5 liter.
Just step by step. 12,000 is your annual demand, and then the ordering
Yes,
cost
sir.
is 75 per order.
Yes, sir.
Annual demand ordering cost 75. Okay, and then carrying cost is 20%. 20% of the cost of the tire, and that you need
Yes,
to
sir.
consider means 12,000 multiplied by 25 multiplied by 20%, right?
Yes, sir.
We need to
So it's
calculate.
5 tire per year.
Just a minute. You need to consider only per tire cost.
Yes, sir.
Okay, so it is 5
5.
carrying cost. Okay, so after that, like
2 multiplied by 12 multiplied by 75 by 5.
just square
So
root
it's 360.
of square root of 2 multiplied by 12,000 multiplied by 75 divided by 5.
Divided. Yes, sir. So 360 in under root.
Yeah, so it is 600, not 360.
No, no, sir.
12,000.
Sorry, I'm calculating through under root.
Yeah. I
Root.
also square root. I also consider.
Yes, sir.
Okay, so it is basically
300,
600 is basically
300 tire.
no 600 is the per order quantity. See, here also I consider the square root. So 2 multiplied by 12,000 multiplied by 75 divided by 5.
Yes, sir.
Okay, so it comes 600. Yeah. So number of orders per year. So for one order, it is a 600 quantity. You want to order 12,000 quantity. So it is 12,000 divided by 600. So it is 20 orders. Correct?
Yes, sir. Yes, sir.
Okay. Then the third, average annual ordering cost.
The average annual ordering cost 40 multiplied by 75 is 3,000.
Ordering
No,
cost.
sorry, sir. Sorry. 300 divided by 2.
No. 20 order
So,
in a year and the per order 75 is cost. So it is 1500.
yes, sir.
Okay. So it is number of order. Just a minute. Number of order. Uh, Ordering cost in year. Then this is basically the EOQ. Yeah. What is the
Yes.
next question? Average inventory.
The average inventory is 300 divided by 2 equals to 1.5, sorry, 150 tires.
Why? Because if in a per order I am getting a 600 tire, so it is 600 divided by 2. So 300 is my
Yes.
average inventory.
Yes,
Okay,
sir.
because on first day I am getting 600 tires and last day it is 0. So 600 divided by 2, it is 300. Then
Yes, sir. Yes.
then average annual carrying cost.
40 multiplied by 75.
Carrying cost per tire is 5 and the average
Okay, okay.
inventory is 300. So 300
So
multiplied by
1
5.
1500. Yes, sir.
Yeah, average carrying cost. Any doubt here?
No, sir.
Okay. And then the total inventory cost. Okay. So if I consider the value of the inventory, which is basically average inventory, I am keeping 300 multiplied by 25 plus 1500 and 1500.
Yes, sir.
1500 is my carrying cost and 1500 is my ordering cost. So it is 10,500.
Yes.
Okay, like this. Or like you can keep the 300 as well because 3000. Because
Yes, sir.
yeah,
I'm taking
you need to,
3,000 but
yeah,
plus 750 equals to 3753.
750 for what?
That, sir, annual carrying cost. 150 multiplied by 5. 550 every cost. So it's 150.
No, average carrying cost we already calculate 1500 and the average ordering cost in a year is a 1500. So it is 3000. Okay. And inventory cost
Okay.
I'm not adding because we can add basically, but this is for throughout the year and inventory we are considering for a particular interval. So that's why we just need to mention 3000.
Okay, sir.
Okay. Then question number 5. You can take a 10-minute time.
So, Mr. Can you enable chat box?
Just a minute. Uh, 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 Chat box. मुझे यहाँ पे दिख नहीं रहा है. What is the issue?
I just want to share and return. So it will be.
Can you share on a WhatsApp?
Yes, sir, I'm saying.
Yeah.
I just said.
Yeah, just a minute. Okay. So you can take a कितना बजा अभी? Okay, 3 minutes and then we start.
Yes, sir.
Sir,
Yeah.
sir, this document you have not sent it in our group. I think you have sent it in the other group. Can you send it in our group also?
There is a 24, 26 group. I think, just a minute, let me check. Or can you send a hi for that group so that I need to check why, whether I am added in that group or not.
Yes, sir. Sir, it's July 2025 group.
Okay.
I sent.
Yeah, okay. Let me. I'll do it. Yeah, you can check now.
Yes, sir, received.
Mm. But why you have not informed earlier?
Sir, I was just solving with the sum which you showed in the
Okay,
thing. So,
because the simulation is big, so you cannot just go through whatever I'm showing right now. But okay, no problem. You can take a 5 minute and then we'll start.
okay, sir. Sir, and for the midterms, how will it be, sir? Will it be like MCQs or like question and answers?
Let me check with Sudipta and then I'll get back to you.
Okay, sir. Sir, and the portions is the first two modules, no, sir?
Yeah, first two modules only. Yes.
Okay, okay, sir. Thank you.
Yeah. So can we start now? Okay.
Yes, sir.
So first, can company consider the purchase of machine? Okay. So salvage value they gave, hurdle rate, annual net cash flow, useful life, and the cost, and present value for 6 years. Okay. So first we need to calculate the payback period. Payback period we can calculate. Yeah, payback period we can calculate easily. Cost. Annual net cash flow is 320. So cost is 1200 divided by 320. This is my first payback period.
Yes, sir.
Okay, it is 3.75. So 1200 divided by 320. That is the payback period. It is simple because it is not the discounted payback period, so you can calculate easily. After that, accounting rate of return, ARR. So ARR you can calculate the information useful life annual. Hurdle rate they give, cost 1200 and the annual cash flow. Uh, 1200, annual net cash flow 320.
Minus 200.
No, minus 200 for depreciation. Useful life 6 years. Yeah. So see, accounting profit is basically the cash flow minus depreciation.
Yes, sir.
Okay. So which is basically the cash flow is 320 and the depreciation is 200, means 1200 divided by 6, useful life is given. So it is 120. 120 we are getting on investment of 1200. So accounting rate of return is 10%. What you consider here? Why you consider the 600?
Investment well divided by 2.
No, investment is a one time. It is a upfront thing.
Average, average,
No,
average investment
see, try to.
12,000.
Yeah, it is not the average. It is a one time investment. If it is a working capital, then we need to calculate the average one because it is replace. Okay. But for the capex investment or the non-current investment, it is a one-time throughout the product cycle. So you need to consider 1200 only.
Okay.
Okay. Internal rate of return. Internal rate of return is not calculated. Okay. So internal rate of return is we need to calculate where the net present value is 0. Internal rate of return. Okay. So
Okay.
how we can not so okay. So it is basically like means 1200. Okay, this should be 320 multiplied by X amount. Okay, 320 multiplied by X. And that X should be, we need to see where, the 6 year project life cycle. Okay, so it should be 1200 divided by 320. So it is 3.75. Okay, So where I can get the 3.75 in a like discounting table. So this is basically 3.99 or 3.78. So it is more close to 15%. Okay. So see how we
Okay.
calculate the internal rate of return. 1200 supposed to be net present value of the equal to net present value of the future cash flow. Okay. So 320 is a yearly cash flow, but I need to see what factor I need to attach so that this 320 will become the 1200. So 320 multiplied by summation of discounting factor for 6 year. So 1200 divided by 320, it is 3.75. So means the rate of return where discounting factor which I need to use where the summation of 6 year discounting factor is 3.75. So if I see this, this is the summation of all 6 year discounting factor at various discounting rate. So it is more close to 3.75 is more close to 3.78. So I need to consider the 15%.
Yes, sir.
Okay. Then net present value. No, accounting internal rate of return is yes, and net present value. So net present value is basically 320, and we need to consider the hurdle rate. So hurdle rate is 10%. So 6 year 10%, which is 4.35. 4.35. Okay, so 320 multiplied by 4.35, which is 1392, and then we need to reduce the 1200, so which is 192 approximately. 194, yeah, more or less it is the point issue. So yeah, net present value is 192 or 194, correct. And then last is profitability index. So it is basically the inflow 1392 divided by 1200, so which is roughly around 1.63. Yeah, more or less correct, 1.16. This is profitability index. So present value of the outflow inflow divided by present value of the outflow. So here 1200 is only one time investment at the start of the project, so we need to consider as it is 1200, and 1392 is basically the present value of 6 year inflow. So 1392 divided by 1200, which is 1.60. Correct. So you can read the next question. You can take a 10-minute time. Once you finish, just raise the voice.
Sir, we can start.
Okay, so we go one by one. So first is basically,
Sir,
yeah,
growth rate increased 9 to 14, so ROI is decreased
ROI,
because expense.
ROI,
ROA decreased
return on
because of expense
asset
increase.
get decreased. Yeah. Second,
Sir, there is a quick ratio is 1.15
one point good.
and inventory purchase
Yeah. So both
1.5. So quick ratio decreased.
quick ratio get decreased because the cash goes down. Correct.
Yes, sir.
Next.
And third is, sir,
Yes. Third.
the decrease in current ratio decreased
Okay. See, will
because paid from cash.
okay. Will evaluate.
Yes,
Okay. So it is 1.7. That means
yes,
one current. I mean the current asset and the current liability. Okay, it is basically the 170 and 100. Okay, what is given here? Amount payable as per with fund from the cash account when the current ratio is
yes, sir.
amount paid. Okay, so say for current liability is 50. Okay, so what happened here? 120 new ratio and here 50, the same amount. Okay, now you can see 1.7 and here it is 2.4, so it get increased, not decrease. Okay, see, in exam I tell you it is very confusing, so it is better take an example and calculate. You have a ample time in an examination.
Yes,
Okay, so don't get I mean don't be hurry and giving an answer. Okay, just take an example and try to calculate, you will get the correct answer. Next.
sir, it increased because LIFO raise
LIFO
price,
to
so
price is increasing,
turnover
so
will
yeah,
increase.
uh, method to LIFO,
And
period of raising prices. So inventory value goes down. So average inventory we put in a denominator. So that's why ratio is increase. Correct. Next.
net profit margin is decreased.
Net profit margin get
Decreased.
decrease. Yeah, because write down of inventory. Yeah, so it will affect the net profit margin. Correct. Then next.
Sir, increased 50,000 from 50,000.
Asset turnover.
Hmm.
A company expenses its development cost of 30,000 instead of capitalizing it. So asset value instead of development cost of 30,000 instead of capitalizing a company expenses. Okay, so
Yes, sir.
definite asset turnover is basically sales divided by the asset. Okay,
Yes, sir.
okay. So value of the expense out. So value of the asset is less. So it is higher. Correct. So it is higher
Yes, sir.
than 8.
Sir, it is increased.
Debt to asset.
Good. Yes, sir. Because of goodwill.
Yeah, it is higher because the asset is in denominator and the debt is in numerator. If we impair the goodwill, then it is the first effect goes to the profitability and the second effect asset get reduced. So
Yes.
denominator is less, so it is higher. Yeah,
Yes, also increase.
yeah. Then question number 9. Market interest rate increases.
Sir, increase. So increase. Sir, is increase.
Market rate interest rate increase. Why it is increase?
Sir, because market interest rate is increasing, so debt to equity
Yeah.
increase.
See, what happen? I mean, if the market rate increases, so is it affect to the debt or equity?
Debt,
Affect to
debt
debt.
to equity.
Yeah,
Debt to equity.
correct. So debt value goes down or debt value increases.
Also, yes, sir.
Okay. So um, okay. So debt value increases or decreases.
Increases.
If the market interest rate increases, then debt value increases. I'll explain. See, like 1000 is a bond value and the interest rate is 6% and the now market rate is 8%. Okay, 8%. Okay, so how we calculate the value if it is a perpetual 100 multiplied by 6%. Okay, but the market rate is 8%, so it is basically divided by 8%. The value of the it is 750. So debt value goes down.
So
So if
debt value goes down or equity goes up.
sorry, debt value goes down,
Equity goes up.
goes up.
Yes,
Correct,
sir.
correct. So that is the logic here. Okay, right, absolutely. Okay. So whatever may be the loss that we need to consider as a unrealized gain, which is added to the equity. So denominator increases and numerator decreases.
Yes, sir.
Okay. So it is lower. Clear? Then 10.
The turnover is increased. So day of payable increase. So cash circle will decrease. Cash circle will decrease.
The number of days payable increases.
Yes, sir.
Okay. So cash conversion cycle
Is decreased.
decreases. Okay. See, keep in mind, inventory turnover increases. That means we are rotating the inventory more number of times in a year. So that means holding in days holding or inventory holding days is less. Okay. So again, my cash conversion cycle reduce, operating cycle reduce, and then I'm increasing the payable days. Okay. So that is again a support to decrease the cash conversion cycle. Okay. So it is not the indeterminate, it is basically the decrease or lower. Cash conversion
Yes, sir.
cycle is lower.
Yes.
Okay. Next 11.
So determinate because temporary method and local currency.
We measure sales temporal method when the local currency is depreciating instead of translation. Okay.
Yes, sir.
So what is the impact? Means
So intermediate.
just a minute.
Intermediate. Sorry.
See what happened if the functional currency is same as the parent presentation currency, means reporting currency, then you need to use the temporal method. In temporal method, means you will see this chapter in more detail, but slightly we touch in the module 2 as well. Okay. In temporal method,
Yes.
what happened? Like the stock cost of goods sold, we are maintaining it a historical cost, any non-current asset.
Yes, sir.
Okay.
Yes, sir.
Okay. So because of that reason, this is basically the lower.
Yes, sir. So
Okay.
lower.
Yeah, it is lower.
Okay.
When the local instead of translation. Okay. Because it is local currency is depreciating, na.
Yes, sir. Yes, sir. Yes, sir.
Okay.
Yes, sir.
Then question number 12.
So intermediate
Changes from euro to US
because
dollar.
euro to US dollar.
Huh.
Currency change from euro to US dollar.
But we are not aware, actually it is a partial information. Means we need to have an information
Like
about depreciating or appreciating.
uh, we deal with it in accounts like with far. So that's why I'm guessing.
Yeah. So here you can mention no change, because in this scenario there is no meaning, because see what happened generally, like if I am converting from euro to US, okay, so receivable turnover sales we calculate with the average rate, and the account receivable we are calculating with the closing rate. Okay, but as we don't have an information, so either you need to mention the no change or indeterminate.
Okay. I prefer interpret.
Yeah. Then question number 13.
So it's double declining. So it's decreased.
From method change to double from straight line. So in straight line method, we are charging the depreciation which is less. So profit is more or
Yes.
EBIT is more. But now we are shifted to double declining, so profit is less. Okay, so
Yes,
EBIT
sir.
is less. EBIT means it is in uh, uh, numerator, and the interest is in denominator. So numerator decreases because we shifted to double declining method.
Yes, sir.
Okay, so that's why it is lower. Okay.
Yes, sir.
Okay. So tomorrow we will start with the new module. Okay.
Yes.
Okay. Anyone has any issue? I just expect some discussion from everyone's side. Okay. Okay. Bye then.
Good night, sir.
Good night.
Thank you, sir.
Thank you.